Hello, my dear listeners. I am Dr. Richa Bhatia, Associate Professor, Department of Commerce, the Bhopal School of Social Sciences. And today I'm here to discuss a very interesting and important topic, that is the old tax regime versus the new tax regime. Why was it implemented? Which one is better? All these things we are going to discuss in our content. We are going to discuss the existing tax scheme, the new optional tax scheme, what are the exemptions and what are the rebates that we have to forego in order to opt our new optional tax scheme, as well as the analysis of both schemes in part 1. In part 2, we are going to see some examples which will give a more clarified picture of which scheme we should opt, and we are also going to see some latest update given on Budget 2023 relating to the new tax regime. So let us start with our existing tax regime. As you all know that in India, income tax is levied on individuals and Hindu undivided family on a slab system. Slab system means that rates are decided for different income groups, which is progressive in nature. That is, as your income will increase, the rate of income tax will also increase. When we talk about the income taxpayers, they are divided into 3 groups. The first is the individuals which are below 60 years, both resident as well as non-residents. The second is the senior citizens who are above 60 years of age but less than 80 years. And the third category is the super senior citizens who are above 80 years of age. The slab for all these 3 groups is different. Apart from the tax, we also have to charge surcharge and health and education cess if applicable. Now let us have a look on the tax slabs which are applicable for the assessment year 23-24. So for individual up to 60 years of age, as you can see, up to 2.5 lakh, the tax rate is nil, which is the exemption limit. Apart from that, from 2.5 to 5 lakh, 5% is applicable. From 5 lakh to 10 lakh, 20% is applicable. And above 10 lakh, 30% tax will be applicable. For senior citizens who are between 60 to 80 years, the slab is as follows. The exemption limit is up to 3 lakh. Till 3 lakh, no income tax will be charged. From 3 lakh to 5 lakh, 5% income tax will be charged. 5 lakh to 10 lakh, 20% income tax will be charged. And above 10 lakh, 30% income tax will be charged. For super senior citizens, that is above 80 years of age, up to 5 lakh, there is no tax, that is this amount of income is exempt. From 5 lakh to 10 lakh, 20% income tax is applicable, and above 10 lakh, 30% income tax is applicable. These are the rates for assessment year 23 and 24. Now, coming on to the new tax regime. When was it introduced and why was it introduced? The new tax regime was introduced in the Union Budget 2020 under Section 115 BAC, where the individuals as well as the Hindu undivided family have an option to pay tax at a lower rate. This scheme or this regime came into existence in the financial year 2021 and from the assessment year 21-22. Now, this scheme is optional, but if an individual or Hindu undivided family will opt for the new tax regime, in this case, they will have to forego, or I must say they sacrifice some exemptions and deductions which are applicable for the old tax regime. Now, Why was the new tax regime implemented? The new tax regime was implemented with a view to increase the disposable income of individuals and Hindu undivided family, and also to make the tax laws and the tax structure more simpler. But in this transition phase from the old tax regime to the new tax regime, there may be some complications where the taxpayer may not be able to decide that which scheme he or she must opt. For that, a clear picture of what deductions and what exemptions we have to forego in order to opt the new scheme, as well as what will be the income tax payable if we opt the new scheme, should be very clear. So now, let us have a look at the rates that are applicable under the new tax regime. Again, this is for assessment year 23-24. For the assessment year 24-25, these rates have been revised, and that I will tell you at the end of our content, that what were the major changes that were made in budget 2023. So for assessment year 23-24, the rates are up to 2.5 lakh, no tax will be charged under the new tax regime. From 2.5 lakh to 5 lakh, 5% is applicable. From 5 lakh to 7.5 lakh, 10% is applicable. 7.5 lakh to 10 lakh, 15% is applicable. 10 lakh to 12.5 lakh, 20% is applicable. 12.5 to 15 lakh, 25% is applicable. And above 15 lakh, if you opt the new tax regime, you will have to pay 30% of tax. Now, what are the exemptions and deductions that you will forego or you will have to sacrifice if you opt for the new tax regime? That is very important for every taxpayer, whether an individual or Hindu undivided family, to know. So these are the deductions that you will have to forego. Number 1, leave travel concession, which is applicable for a salaried individual. This is not applicable in the new tax regime. House rent allowance, again applicable for salaried individual, but not allowed in the new tax regime. All the other allowances and the allowances which are given to the members of Legislative Assembly are also not allowed, or I must say they are blocked when you talk about the new tax regime. Any kind of deduction that is applicable for minor, which is 1500 per child, is also not applicable. Standard deduction of 50,000, which is applicable for a salaried individual, is again not allowed in the new tax regime. But this deduction under budget 2023 has been made applicable, which I'll tell you later. Interest on self-occupied or vacant property and any kind of additional depreciation is again not allowed. Deduction for family pension, which was 1/3 of the pension or 15,000, whichever is less. This is the deduction, but it is not allowed under the new tax regime. All the other deductions under section 6A, that starts from 80C to 80U, are not allowed under the new tax regime. But there are two deductions which are applicable for both. The first is 80CCD subsection 2. This deduction is regarding contribution in National Pension Scheme, and it is allowed in both the schemes. And 80JJAA, this deduction is allowed to the businessmen who promote new employment opportunities. This is also applicable in both the schemes. 80C, which is applicable for life insurance premium, public provident fund, investment, again in new tax regime is not allowed. 80D, which is again very commonly used and claimed for health insurance again is blocked in the new tax regime. 80DD, that is expenditure incurred for the medical treatment of a disabled dependent, and 80DDB, which is applicable for medical treatment of a specified disease, again both are available for individuals but not allowed under the new tax regime. 80E, again very commonly claimed, which is interest paid on the higher education loan. This is also not applicable for new tax regime. 80G and 80GG. 80G is for donation and 80GG is rent paid for a residential accommodation, again are blocked in the new scheme. 80QQB, which is again very commonly used for royalty for books, applicable for individuals but is again not allowed in the new tax regime. 80RRB, which is for patents. 80TTA, which is very commonly claimed as interest on saving bank accounts. 80TTB, this is for interest on post office. 80U, which is person with disability. These deductions are also not allowed under the new tax regime. Apart from that, all the other exemptions for special economic zones under section 10AA and all the other deductions for donation of expenditure on scientific research again are not allowed under this particular scheme. So even if we have the knowledge of all these deductions which we want to forego, it is very important for any taxpayer to first calculate the tax liability as per the old and the new tax regime and then decide that which option is better for them. For that, we are going to see some examples which I am going to discuss in part B. Till that time, happy learning. I hope you understood the difference of old and new tax regime. We are going to see the practical part of it in our next video. Thank you.